Hi, my name is Michael Myers. I'm a reverse mortgage specialist with Mutual of Omaha Reverse Mortgage. This is my 19th year in the business doing exclusively reverse mortgages. I've helped hundreds of families with their reverse mortgage needs. It concerns me and sometimes saddens me that more individuals, couples are not taking advantage of this valuable program to help them live a more secure retirement within their own homes. Most of the time, it's because of a lack of knowledge. And that is the purpose of this video today. We'll start with the basics. Feel free to pause this slide and take a look at some of my background and find out how a guy who came out to Washington as a Navy attorney ended up becoming a reverse mortgage specialist for Mutual of Omaha. Bottom line is I love my job. I've helped a lot of people and I love educating. So let's get to it. The most popular reverse mortgage program and the one that we will be talking about today is called the Home Equity Conversion Mortgage, otherwise known as HECM. It's an FHA government-insured program that was put in place in 1988 under the presidency of Ronald Reagan. Over the years, this program has evolved to kind of roll with the times. And in general, each evolution has made it more secure and protective of retirees. So, what is a HECM? A HECM is the reverse mortgage. A reverse mortgage is really just a loan. It's a mortgage like any other mortgage, but it is one that allows people who are 62 and over, so that's one of the qualifications, draw out equity from their current home without having to make a mortgage payment as long as they live in the property. When the last borrower or non-borrowing spouse, which we'll talk about a little bit later, leaves the property permanently, that's when the loan becomes due. Anything above that amount in terms of the value of the property belongs to the borrower or their family. But should it happen that they end up owing back more than the value of their property when they leave the property, that's when FHA comes in and makes sure the lender is paid the difference between what they owe and what the property is worth, and the family has no further obligation. To be eligible as a borrower on a HECM reverse mortgage, you have to be at least 62 years old. You can have a spouse who is not yet 62 years old, but they will not be a borrower. The benefit of having them involved in the process is that in the end, a reverse mortgage needs to be paid back when the last borrower leaves the property permanently. However, if they have an eligible non-borrowing spouse, then that spouse can stay in the property as long as he or she would like to without having to pay the mortgage back until they leave the property permanently. Some of the responsibilities of the borrowers include continue to pay your property taxes and homeowners insurance on the property. If you have HOA dues, you must pay those as well. And maintain your property in good shape. There's no inspection after the fact, but that's one of the requirements. The benefit that's talked about in this slide is really the loan amount. What is the principal limit? That's what we call it on the reverse mortgage side. How much, what percentage of the value of the property will we allow you to access? That principal limit amount is based on the age of the youngest borrower or non-borrowing spouse, the appraised value of the property, and there are some limitations. If a value of a property is over $1,149,825, we're going to base all our decisions on that value, even if the property is worth more. So we're going to back off that number based on the age of the borrower or non-borrowing spouse and today's interest rates. So to lower the rate, the higher the principal limit, because the presumption is there'll be less interest accruing over the life of the loan. So we'll allow you a little bit more access to your equity when rates are lower. How do you receive the benefits, the proceeds of the reverse mortgage? Well, first of all, we do have to pay off any underlying debt associated with the home, which means if you have a mortgage and a second mortgage, we have to pay off those mortgages first. Any principal limit available after that can be taken out a number of ways, including taking a lump sum at closing, setting it up on monthly payment plan where it just gets deposited into your account, into your bank account, or you can let it sit there as a line of credit. And this is one feature we'll talk a little bit about in coming slides. So what are some of the common benefits of reverse mortgages? Well, first of all, it's a non-recourse loan, which means if you end up owing back more than the value of your property when you leave the property, because that's when the loan is due, you or your family are not responsible for that deficiency between what you owed and what the home was worth. That's where FHA comes in and pays the lender that deficiency, and that's called non-recourse. So that's a protection and it's a benefit. The funds that you pull out from a reverse mortgage are not considered an income. It's just a return of your own equity. So you're not going to have to file a tax return to report money that's been deposited into your account with the reverse mortgage. We always recommend you consult with a tax specialist, but that is the rule. You can use the funds for whatever you want. So we won't get into all the things you could do with reverse mortgage funds, but as long as it's legal, you can do it. There are no prepayment penalties. So I've had plenty of people who've made payments on a reverse mortgage. Every month you get a monthly statement. It shows what your loan balance is, how much interest added on to that loan, because if you don't make a payment, and that's most people don't, we're going to add interest onto that loan for that month. And so the next month we're going to give a statement that shows additional interest added on. Sometimes they're still working and do a reverse mortgage and they still want to make a payment as long as they're able. No penalty at all. When the loan is actually paid off, when the last borrower or non-borrowing spouse leaves the property, there's no penalty. There's no prepayment penalty. So if you can pay it off, 2 months after you put it in place, there's no penalty. Here's a real benefit that I think it's not really overlooked, but it's not highlighted enough, and that is the line of credit that's created after paying off any existing debt, any funds left over that you just say, hey, I just want to have a line of credit that I can draw from whenever I need it. So you're not charged interest on it until you use it. When you do, it gets put onto the balance of your loan. But the really nice thing about this line of credit, it's guaranteed, so it cannot be reduced, it cannot be frozen, and it cannot be eliminated. And in fact, it has a growth factor so that every single month, that line of credit is going to increase your availability to draw out more based on the same interest rate that is being charged against what you have used. So it's a beautiful thing and much different than a bank home equity line of credit. So another benefit is when and this gets into the non-recourse nature, when the loan becomes due, you won't owe back more than the value of your home. And if the family wants to keep the home and you owe back more than what the value is, they can purchase the home for 95% of the appraised value at that time. So there are some really great protections put in place. Some of the most common uses include the following. First of all, to eliminate a monthly mortgage payment. So sometimes that's all we do with the reverse mortgage is pay off an existing loan for which you do have a monthly mortgage payment, and replace it with ours where you don't have to make a payment, thereby freeing up that cash flow. Most of my customers are on a fixed income. Sometimes it's only Social Security. And if they can get rid of that monthly mortgage payment of principal and interest, because remember you have to pay your taxes and homeowners insurance, then that extra money can go a long ways, especially in these times, high grocery costs, gas costs. A common use and is sometimes it's just, hey, I want to put a big line of credit in place. And I talked about that earlier, where it's a line of credit that can never be closed or frozen, unlike the loans you get through a home equity line of credit through banks, where you do have to make a monthly mortgage payment, but at some point, the bank can actually just close that loan down. Ours cannot be closed, and in fact has that growth factor. And then a very common one that's up and coming is that people can use this program, the HECM program, to purchase a new home for which they won't have to make a mortgage payment. And generally the way that works is you sell your current home, you have a big chunk of money, you might even have enough to pay cash for your next home, but instead of doing so, you come in with a large down payment. We fund the rest with the HECM loan where you don't have to make a monthly mortgage payment. And then in so many cases, you'll have extra proceeds from the sale of your home that you can just keep in your pocket. So you've accomplished the mission of not having a mortgage payment, but now you still have some liquidity. And so that's a fantastic program that really was one of those updates that Congress made in 2009 to the program that was initially put in place in 1988. Other common uses include just consolidating and paying off current consumer debt, paying off those high interest credit cards with a loan that you never have to make a payment. It's available to supplement your monthly income. So we can set the available proceeds after paying off your existing mortgage up on a monthly payment to you if you'd like. So not only are you not having to make a payment anymore on your mortgage, you're actually receiving some extra funds. It's an excellent retirement planning tool, especially in times where markets are fluctuating. You may also have an IRA, a 401k, but in times where it's going down, people tend to continue to draw out on those accounts at the same amount that they were when it was really growing. And that might deplete those accounts faster than intended. So if you take your required minimum distributions from the retirement account, but then supplement that with a draw from your reverse mortgage to meet your needs, now you're going to keep those other assets intact. So that's a real retirement planning tool. There's, I've had a lot of my customers do upgrades on their homes, repair them, get them ready for aging in place, putting ramps, grab bars. It's a really great way of using the funds. And next to talk about healthcare costs, we all know that everything's getting more expensive, and so this is a great way of paying for current healthcare costs and for long-term care needs. Most of us really don't go into retirement with a strong long-term care insurance policy that will pay some of our needs if we wanted to stay at home. And this is a fantastic way for paying for those needs. You're not really creating a cash reserve for emergencies with the reverse mortgage unless you actually took out funds and put them in a cash reserve account. That's not really recommended, because if you take it out of the reverse mortgage, which you're able to, you're going to accrue interest on that, right? So most of the time, you're not going to get the same return of interest if you just put that money in the bank as you're paying on that money for using it. So in terms of cash reserves, that will be available to you in the line of credit, and you won't be charged interest until you use it. But it's a fantastic way to pay for emergencies. I love this next one, funds for travel and recreation. Listen, I've had many customers use their reverse mortgage funds for travel, to buy a new car, a camper. I love it when people enjoy their retirement. I always caution people to be conservative though, because you do want to make it last as long as possible. And then, of course, we did mention the purchase home again. Common safeguards include those listed below. The first one is probably the biggest, that it's a non-recourse loan, meaning you'll never owe back more than the value of the property when the last borrower or non-borrowing spouse leaves the property. Homeowner retains title to the property, so you could turn around the next month and sell the property. Its title is still in your name. No title changes hands at the time of doing a reverse mortgage. So that's a big misconception, that you're giving your bank to your house to the bank or to the lender. That's just not true. You are entitled to all the remaining equity in the home, which is the remaining value of the property after paying off your reverse mortgage. So that all belongs to you. Or if you pass away while living at the home, then the property does not go to the lender, it goes into your estate, and it will pass under the terms of your estate or under your will or your trust, and the beneficiaries will be required to pay off your reverse mortgage, but anything above that will belong to them. There is mandatory counseling that also was put in place by Congress in 1988, and it's really a protection to make sure that borrowers understand how the reverse mortgage works, how the loan amount was created, how much they qualified for, what their responsibilities are, and when the loan gets paid back. So it is really a protection. It takes about an hour, and it's all done by phone. We talked about the equity line. The remaining line of credit can't be canceled, frozen, or reduced. That's a fantastic feature of the reverse mortgage, which makes it different than a regular home equity line of credit you get through a bank, where first of all you have to qualify for based on your income, and you do have to make a monthly payment, and then at some point you could hit the end of that home equity line of credit and actually have to make a payment out of your own funds rather than continuing to draw from it. So our equity line, our line of credit, is one of the strongest features, and it does grow regardless of the value of the home. So the home value could come down, but contractually, this line of credit grows at the same interest rate and mortgage insurance rate as what is being applied to what you have used, the loan balance. So it doesn't matter whether the value goes up or down. Hopefully I've succeeded in my mission of providing really just the basics of what a reverse mortgage is, who will qualify, what some of the common benefits are, and even dispelling a myth or two. But if I can answer any of these questions, how much do I qualify for? Can I get a quote? Can I use this to purchase as a purchase loan? Feel free to reach out. Feel free to contact me through one of these methods noted on this slide. Even though I'm licensed in Washington, Oregon, and California, I do answer questions from customers all across the country. You can also email me and visit my website at reverseinwa.com, reverseinwa.com, and I think you'll find some other great resources on my site. Thanks for listening, and hopefully hear from you down the road.